This is the story of the 2026 financial freeze. Why your money feels like it's disappearing without moving, and how this moment compares to the infamous 1929 Great Depression collapse. As we dig deeper, you will begin to see the hidden chain reactions that are quietly unfolding reactions that experts once dismissed. Why your savings feel stuck. Why the system is tightening. And why governments, banks, and corporations all seem to be preparing for something they're not fully telling you. Before we jump into the crisis of 2026, we must travel back nearly a century to a very different world, yet a disturbingly similar financial environment. The year is 1929, the age of radio, industrial boom, and unstoppable stock market optimism. Everyone believed the future was a straight line going up. Loans were easy. Speculation was normal. Investors were euphoric. Banks were confident. And the government, they insisted everything was fundamentally sound, invisible to the average person. Until one day, the cracks became fractures. The fractures became collapses. And the collapses became one of the worst financial disasters in human history. Now, fast forward to the mid-2020s. We live in a world full of high-speed trading. Digital currencies, trillion-dollar tech companies, and central banks with more power than ever before. Yet, despite our technology and our progress, the structures that hold our financial world together, those structures remain fragile. Savings are shrinking. Purchasing power is collapsing. Inflation and interest rates are fighting each other like two fires burning in opposite directions. Governments are drowning in debt. Banks are restricting loans while promising stability, and global markets are beginning to freeze in slow motion. This is not a single event. This is a chain reaction. To understand the modern crisis, we have to track where it started, what fueled it, and how it built up enough pressure to trap people's savings, just like in 1929. Crises never arrive with fireworks. They build gradually, quietly. The seeds of the 2026 collapse were planted between 2020 and 2023. 3. Major triggers set the stage. During the global pandemic, central banks printed historic amounts of money. At first, it kept economies alive. But as the printing continued, asset prices inflated wages, lagged real inflation, surged purchasing power fell, savings lost value. This was the first squeeze. People didn't feel it immediately, but the system did. To keep economies stable, interest rates were kept close to zero. This encouraged reckless borrowing, speculative investments, corporate debt bubbles, housing market inflation, government overspending. Then suddenly, central banks reversed course. Interest rates skyrocketed to fight inflation. But here's the deadly irony. The same system that depended on cheap borrowing was now strangled by expensive borrowing. Consumer loans doubled. Mortgage payments skyrocketed. Businesses struggled to refinance their debt. Governments faced historic interest payments. Banks faced silent deposit bleedouts. A stage was set. Pressure had built up. Savings were weakening. A 2026-style collapse became almost mathematically inevitable. Between 2023 and 2026, the financial system looked stable from the outside. But inside, several key components were overheating. People were saving more but losing value. Inflation outpaced savings rates. Banks reduced benefits. Many savings accounts effectively became negative yielding. You save 100 today, you get back 98 tomorrow in real purchasing power. Banks began limiting business loans, mortgage approvals, personal credit, small enterprise financing. Banks call it risk management. But to the average person, it feels like all paths are closing. Governments spent more than ever before. By 2025, debt-to-GDP ratios hit 100% plus. In many countries, tax revenues slowed, welfare costs increased, interest payments exploded. They needed money. They needed loans. They needed your savings. And that's when the system quietly began trapping liquidity. Companies relied on cheap debt. When rates rose, refinancing became impossible, layoffs increased, investment stopped, growth collapsed. Consumers felt the pressure. Markets froze. Confidence died. And that's when the breaking point arrived. Both collapses, 1929 and 2026, share a moment that defines the entire crisis. Liquidity vanishes. Not money disappearing, but the ability to move money freezing. Here's how it happens. Just like 1929, small but increasing numbers of people begin withdrawing deposits, converting savings, buying physical assets, shifting into foreign currencies to stop the outflow. Banks start reducing withdrawal limits, delaying transfers, offering lower returns, increasing fees. This creates the feeling that money is trapped. Investments that were once easy to sell become illiquid. People can't exit positions. Companies can't raise money. Governments can't refinance debt cheaply. A perfect storm. In 1929, the crash triggered panic. In 2026, the panic is quieter but deeper. People stop trusting financial systems. They pull back spending. Businesses shrink. Construction halts. Banks tighten further. Confidence collapses. And once confidence is gone, everything collapses with it. This is where things become frightening. When a financial system freezes, your savings become inaccessible, devalued, restricted, frozen in place. Not because banks steal the money, but because the system forces your money to stay put in order to survive. Examples include withdrawal delays, transfer limits, capital controls, reduced bank hours, slower digital payments, strict foreign exchange rules, new taxes on withdrawals. This is exactly what countries do during crises, and 2026 is no different. People feel the trap in three ways. Inflation eats your savings faster than interest increases it. Banks find ways to delay outflows. When you don't trust the system, every transaction feels risky. And that is the exact fear that connects 2026 with 1929. Governments and central banks attempt multiple fixes, but each one creates its own problems. This makes borrowing easier but risks higher inflation. Savings lose more value. Investment becomes more speculative. More money enters the system. Assets inflate again. Real wages stay stagnant. It feels like a recovery, but it's hollow. Governments restrict. Withdrawals, transfers, foreign exchange, large cash movements. This protects banks but traps consumers. Large companies get rescued. Small businesses collapse. Monopolies expand. Inequality increases. The cycle repeats. None of these fixes solve the root problem. An unstable global financial structure built on debt, speculation, and short-term policies. Now, let's compare the two collapses directly with hard numbers and repeating patterns. 1929 debt to GDP, approximately 40%. 2026, debt to GDP, 100% to 150% in multiple nations. That alone tells us the system today is more fragile. 1929 personal savings rate, strong. 2026 personal savings rate, weakest in decades. People have less margin for crisis. 1929 interest rates, low gives high. 2026 interest rates, zero gives historic highs. Identical pattern. 1929 stock market, overvalued. 2026 tech market, inflated by speculation. Same overheating, just more digital. 1929 banking cracks, silent withdrawals. 2026 banking cracks, silent digital withdrawals. The technology changed. Human behavior didn't. The pattern is simple. Excess money created excess speculation, encouraged interest rates reversed, debt became unpayable. Savings lost value, confidence collapsed, liquidity froze, crisis triggered different time period. Same cycle, same ending. Hit the like button, share this video with someone who needs to hear it, and subscribe for more analysis that cuts through the noise.